樓觀景咁就俾睇，熟下嘅少少。係 VR 睇樓，下載中原地產 App 可以睇到全港筍盤資訊、VR 片段同 video， 助你全天候輕鬆揾樓。有洗頭，洗魚，因為面霜，而家洗洗髮露，點沖洗護髮奢華，時間 enjoy， 我日日有低價。
Can everyone hear me? If you can hear me, maybe help me type a 1 in the chat box. Okay, I see a bunch of ones. Thank you very much and good evening. Welcome to tonight's seminar, Growing Your Retirement Nest Egg with SRS. So those of you who have not seen me before, my name is Elijah. I'm with the Jurong East team, and our topic tonight will be about SRS and how it ties into your retirement. Okay, so thank you for joining on time. We will not wait for any latecomers, so just let me begin. Okay, so yes, that's me. I'm an Associate Financial Services Manager with Field Securities, and this is actually, I think, my 6th year in the industry already and counting. Okay, anyway, before I begin, standard disclaimer, okay, I believe everyone can see the screen. So basically, later today, tonight rather, when I'm speaking, you may see me mention some companies or some products or some stocks or shares or something similar. Okay, please do not take that as financial advice. I'm just actually mentioning them in passing. So you would actually want to seek proper financial advice before you make any buy or sell decision. All right. Okay. So a little bit about me, that's me. I am an Associate Financial Services Manager with Philips Securities, and actually the main bulk of my work revolves around things like critical illness planning, wealth management, how to generate passive income streams for people, and comprehensive retirement planning. Okay. You may have heard me on Money 89.3. I've been on the show a couple of times, and if any of you here are actually on the Seedly platform, you may have seen my responses and answers there, which I try to answer those questions in my spare time. So that is actually my profile on Seedly. Okay, but enough about me. I'm sure all of you are here tonight to learn something. And since it's a Tuesday evening, you know, they always say Monday blues. So I hope your Tuesday is better than on Monday. Let's just make it a little bit more entertaining tonight. All right. So let's begin. Growing your retirement nest egg with SRS. So first thing first, let's talk a little bit about tax. All right, let's talk a little bit about tax and let's examine some global tax rates. Okay, so this table might be slightly outdated, but these are global tax rates of many countries around the world. Most of them, I would say, major economies. And can anyone tell me, okay, so I like a little bit of interaction, just a little bit, of course. Hopefully you can reply to me when I ask a question. Can anyone spot something, or rather, does anyone have anything to say about this chart? Do you notice anything? Like, is there any country that totally don't need to pay tax? I wish it was Singapore, but it isn't. Anyone? No one? No responses? UAE, Raymond, thank you. Yes. So, wow, UAE has no tax. Incredible, right? Can you imagine a place where no corporate tax, no income tax at all, and no value added tax? But of course, that's just one country. The majority of countries will have tax in some form or another. Okay, but we are very fortunate in Singapore. Of course, corporate tax is already among the lowest. I think the only other one that is just ahead of us, other than UAE, of course, is Hong Kong. Right, Hong Kong is 16.5%, just half a percentage point. But to the individual, okay, we don't really look at corporate tax. To the individual, the tax that we will feel on a day-to-day basis will actually be your GST. That's basically on everything that we pay. And of course, when once a year, your income tax, whether are you at the minimum or the maximum tax bracket. The good news is our maximum tax bracket isn't what I would think is very high. If you look at the Nordic countries, Denmark, Germany, Europe, largely Canada, Sweden, yes, I found Sweden. Okay, so all these countries have tax rates in excess of 50%. So basically above a certain point, more than half of what you earn just goes back to the government. So unless you love nation building, okay. But in Singapore, of course, we have a pretty decent maximum 22% tax rate. Hong Kong comes in a bit lower. Brunei has oil money, but we don't count that. And of course, the UAE, as previously mentioned, Switzerland, okay. But other than that, I don't think there are many countries in the world that have an individual tax rate that's actually lower than Singapore. So we also have to be happy about that. Someone said UK, yeah, UK 62%. Yeah, that's very high. Okay, so yeah, that is tax in Singapore. Okay, so tonight focus is on income tax. Okay, so now Singapore's tax system is what we call progressive. So the more you earn, the more you pay. Okay, that's why it's progressive. You don't earn a lot, it doesn't really tax you heavily. Of course, income tax is more of a direct taxation on yourself, whereas things like GST is indirect. You just basically pay on everything that you buy. Okay, so we have a very what we call progressive tax system in Singapore. Okay, and basically we look at this thing called chargeable income. Okay, chargeable income. The higher your chargeable income, the higher your income tax percentage. Okay, so this is how tax in Singapore works. All right. Okay, so how does it look like? Okay, so this is an old picture, but the basic idea still remains the same. You have income for employment. Okay, so that will be your salary, right? So whatever you earn from work, including your bonuses. Okay, now you might minus any expenses. Okay, so okay, for most of you here, I would say this is probably a zero. Okay, because most of your work expenses, your company should be footing it. For example, if you have to travel for work, okay, your company already pays for your air ticket and your hotel, right? If you need to travel for a business meeting, you can always claim your taxi fare back from your employer. So they are reimbursed, so you can't consider an expense. Okay, and if you go on course, okay, you'll be able to normally your company will subsidize you in some form or another. So after you take that, you subtract away that, you end up with what we call total income. And then after that, this is an interesting thing, you actually subtract donations first. Donations do not fall under reliefs. They are actually not part of relief. So you can actually use donations to continue to reduce your accessible income. All right, your accessible income. So let me just erase that. Okay, so now once you have used up your donation in the numbers, right, you are left with what we call a accessible income number. Okay, and then subtracting away your personal reliefs like your grandparent relief or parent relief or CPF relief, you are left with what we call your chargeable income tax. So it's a very straightforward structure. You take what you earn, you minus away, you minus away, you minus away, and then there is one final number, and that number is what they use to determine how much income tax you pay. Okay, so we will be using the chargeable income for most examples moving forward. All right. Okay, so basically after you have calculated your chargeable income, okay, then you need to ask yourself, based on that chargeable income, do I have to pay income tax? All right, so of course everyone hopes no, but that's only in certain scenarios, say, provided your chargeable income after all the reliefs and deductions and expenses and whatnot, okay, you end up with a figure lesser than 20,000. Okay, you have anything lesser than 20,000, you don't have to pay any income tax. Okay, but you are still paying tax because you know everything you buy still has GST. That's the indirect taxation I'm talking about. That goes to the government, but personal income tax that goes to zero. So yeah, you don't have to pay anything, which is good, right? Unless you love nation building. Okay. So the tax brackets actually have changed a lot in the past few years. Okay, and actually this is the latest tax rates. Okay, so let's take a look at it. Okay, so as I mentioned, the first 20,000, okay, you don't need to pay anything, so that's zero tax. Even the next 10,000 actually is not very high, so that's actually 2%. Okay, so that's about $200. Okay, jumps a bit again, 3.5%, 350, but take note this 350 is on that 10,000. So once you add it to the 200 from above, you actually pay 550 tax. Again, I would say that's not really a very high figure, okay? But things change, okay, once you start to enter here, okay? So once you enter the 70% tax bracket, you start to feel like, oh, okay, it's a bit more now, okay? And anything below here, it starts to feel painful. Let's just put it this way. It starts to feel a bit painful, especially if you ever reach double digit 11.5 and beyond. And I've seen clients in this percentage range. So their income tax is basically people's income. So yeah, at that point, it gets painful, but we also must remember the kind of blessings that this is the highest rate. Remember the chart I showed earlier at the first slide. Many countries actually have an income tax rate higher than this. So I think that actually, all in all, we are still quite okay. But naturally, who likes to pay tax to the government? I don't think anyone of us here would like to. Okay, so I mean, there's 51 of us here minus the hosting myself. I think there's 40 plus of you in this room. I don't think anyone here likes to contribute that much to nation building. If you like to, let me know. That'd be very interesting, but I don't think anyone will want to do that. Okay. So generally, the cutoff point, or when I speak to people, the point where it feels painful for them usually starts at 11.5 and beyond. Okay. So that's when people start to think that, it's a bit high on my tax bill. All right. So that is your resident tax rate. Interestingly, actually, you see these brackets of 40,000. They didn't used to be 40,000. Okay, I believe it was 80 to 160. Okay, so actually this 15% was actually introduced in recent years. Okay, before that, I think it was 80 to 160 as a one bracket, and then 160 to 240, and then 240 to 320. But now they have really made it more, shall I say, more spacing, okay, more different layers of the tax. All right. Okay, so that's a little bit of 101 on our income tax system. Okay, so is it possible to reduce your tax to 0? And well, here's a live example. Actually, yes, of course. You can see here that this person, okay, has utilized earned income relief, which everyone gets. Okay, NS-man relief. So obviously he's a guy. Okay, and he's supporting his parents. Okay, and SRS. And yeah, okay, so you can see one thing missing here, there's no CPF, correct? You don't see any CPF. So this just means that this person is definitely a self-employed or a business owner of sorts. So no CPF there, okay? And cost fees, of course, if you're self-employed, then you can actually claim your cost fees, but that will actually be up to a cap of, I think it's 5,000, okay? But ultimately, after all the deductions, we have 0 tax. So it is possible. Okay, it is possible. Okay, so that's just one thing to note. All right. So next thing. So actually, what is this SRS line here? Okay, so now we talk about income tax, and now we realize that there's this line called SRS. What exactly is SRS? So for those of you hearing it for the first time, okay, I see a question. Oh, by the way, there's not many of you here. There's 50, I think 40 plus of you here. So you have a question that cannot wait, ask, and I'll try to answer if it doesn't break the flow of the presentation. So Praveen asked, is cost fee only for self-employed? No, actually cost fee is not only for self-employed, but as I mentioned earlier, if you are working for your employer and they send you on course, usually they're paying. So it's not an expense you incur, which makes it very unlikely for employed people to be able to claim cost fee. Now for self-employed, okay, you can actually claim your cost fee because you pay for your own cost and it's an expense. But when it comes to employed persons, now let's say, here's an example. If you are actually working as an engineer, then you decide you want to quit engineering and maybe set up a bakery, okay? So you went for a baking course, okay? Now, since the baking course is relevant to your next intended occupation, and let's say you really quit your engineering job and went to do set up a bakery, okay, that baking cost that the money that you paid while you were still an engineer, you can actually offset it against your tax. And if I remember correctly, you are allowed to actually split up or even defer a little bit of the cost fee to future years income tax. Okay, now because I don't have the IRS webpage in front of me right now, but if you go to the IRS webpage, they will actually explain in detail how each of all these reliefs that you see here work, and how you may use them to your advantage. Okay, but generally speaking, if you pay for a course yourself and it's relevant to your work or your upcoming line of work, there should be some way for you to claim your cost fee. So I hope, Praveen, that answer your question. Okay. So yeah, if you are employed, Praveen, and your employer send you on something, I'm sorry, you can't claim. Okay. Okay. So anyway, so this SRS line, what is it about? So SRS actually stands for Supplementary Retirement Scheme, which also just happens to be today's topic. Okay. It is actually a government strategy. This is something that the government came up with, and basically it's to help people plan and prepare for old age through, I wouldn't say forcing, but enticing, making it making it better for them to save up, so to, I would say lure either, but entice them basically to set aside more money for old age. Okay, in Singapore, our social security, CPF, pension, right, the CPF line, okay, that is something that the government mandates. So you can't run away from it pretty much. But SRS, now the government doesn't want to force anyone into anything. So they just make it a optional scheme. But it is there should you want to utilize it. And trust me, if you utilize it, there will probably be quite a fair bit of benefits. Okay. So this is basically a government scheme. Okay. Now it is voluntary. Okay. You are not required to utilize it every year. You can utilize it this year, and then let's say maybe you change job and then you took a salary cut and then you realize that it wasn't worth utilizing SRS. Okay, then don't do it for that year. And then maybe next year your salary go up again and then you want to use it again, by all means, go ahead. Okay, so it is a voluntary scheme. There is no one forcing you to do anything. Okay, okay. So basically, when you contribute SRS every year, it can confer upon you tax relief based on the dollar value. Okay, so the entire amount you contribute to SRS gives you tax relief for next year. Okay, so you contribute now, and now it's 2021. You will not see this tax relief applicable to you until 2022 assessment, year assessment, which is next year. Okay, and the SRS scheme is operated by the 3 local banks, so you can only open it, the SRS account, with the 3 local banks, and you got to be at least 18 and not an undischarged bankrupt to open. Okay, see another question. SRS PYC, we can contribute. There is no age limit actually. If you are working and you have not taken out your SRS, you can always contribute. Okay, but you are of course subject to the cap. Okay, and what is that cap? That cap is 15,300 for Singapore citizens and PRs. Previously, it was a bit lower, but they raised it some years back. Okay, and for foreigners, it's $35,700. Okay. If you are a foreigner here in this class, and let's say later this year you become a PR, okay, it will be prorated accordingly. Okay, this one I experienced firsthand. I have a French lady who is my client, and she basically converted to a PR, and yeah, it got prorated in the end. Yeah. Okay, now you can make the contributions anytime during a calendar year. Most people tend to contribute at the end of the year. Okay, but actually there's no need to do that. You can contribute anytime during the calendar year, but the most important thing is your contribution must be received by your bank before the end of the last business day. If they don't receive it at that point, you will miss it, and then it counts to next year's contribution, which can be a bit of a pity. So give me a second, let me just drink some water. Okay, I see some more questions. Lee asked, for tax relief purpose, should I consider contribute SRS first or CPF? Good question. This is very subjective. Okay. For example, myself, okay, I actually not doing much contribution to SRS personally. I am actually doing CPF right now, but that's just me. Okay, please don't copy me, because I have evaluated my circumstances. I did my numbers, and I decided to do retirement sum topping up first before I go to SRS. So basically, I'm leaving my SRS for a little later. Okay, but let's say today you are 50 years old, let's say, and your SA already maxed up. You only have SRS left. There's nothing left. There's no other option if you want to relieve, get the tax relief. So Lee, I would say that please look at your circumstances. Okay, a lot of factors to consider, including how close are you to full retirement sum, what's your current age, when do you intend to retire, and then there's actually probably an optimal age for you to contribute to SRS, and that really depends on your personal circumstances. Okay, so yeah. Okay, and AY asks, do we contribute in January or December? Which months are better? Okay, if you already know you are going to be in a very stable job for the whole year and you want to contribute in January and start to deploy your SRS funds, there is nothing wrong with that. You can do that, no problem. Okay, you contribute in December, just make sure you don't miss the deadline. And again, there's nothing wrong with that also. Why that is so is because regardless of when you contribute, the money that is sitting as idle fund in the SRS account with the bank is actually earning 0.05%. Okay, despite the word retirement in SRS, the R, okay, this SRS account does not earn 4% interest like your CPF special account. So please take note. I have met some people who actually told me, contribute can already, 4% ma, but no, it's not 4%, it's 0.05. So you contribute. Okay, Richard asked 0.05 question mark. Yes, SRS funds not deployed and left in the bank earn 0.05%. They earn the prevailing bank interest rate. Okay, so here's the thing. You contribute 15,003 and earn 0.05, that is $7.50 by the time you reach end of the year. Okay, you contribute in December, you don't earn that 0.05, so you miss out maybe $7.50. But in the grand scheme of things, I don't really think $7.50 is going to make a lot of difference in your retirement lah. So AY, I think personally, you want to contribute in January probably means you're very confident your income for the whole year is going to be high enough to warrant the SRS contribution, and then you want to just deploy, contribute first, and then after that, figure out what you want to do throughout the year. If you are the sort that, your income would be heavily dependent on a year-end bonus, okay, then maybe you want to wait until your year-end bonus announced, then you figure out how much you want to contribute, or maybe you want to max out at the end of the year. So a lot depends on personal circumstances. Personally, if I'm going to contribute SRS, I'm self-employed, all right? So by a certain point in time, maybe October, November, I have an idea of what's my income for the whole year, and then I will contribute at one shot. So for me, my style probably, one shot. But some people, okay, and I have these clients, some clients who set up a standing instruction, they actually contribute 1,275 every month. Okay, so their jobs are stable, their salary is fixed, and they don't want to do a lump sum because it's very painful for them at one shot. So what they do is they contribute 1,275 every month. They set out a standing instruction because 1,275 times 12 is 15,300. That's how they get the number. Okay. Okay. Praveen says thing do in September and invest in September as a very volatile month. Okay, I cannot comment really much on that. No, this year's September and last year's September's are very different, and of course we can't tell what September's are. You can look at history, of course, but they are merely just indications. You may have a September next year that is actually very flat, for example. Okay. Anyway, the relief you get is computed for next year. Okay, so that's something to take note. Okay, now, so yeah, so what I said, if you contribute this year, your income tax for next year will be able to enjoy this relief, and that is based on your income earned this year. Okay. Okay, so what's the benefit of SRS? As I mentioned, every dollar you put in, you will reduce your taxable income by $1. Okay, and maximum relief which you can enjoy is 80,000. Okay, that you can enjoy every year is 80,000. For guys, men mostly, it is not that easy to hit 80,000. I think technically it's possible, but not easy. Okay, for women, actually quite easy. If you have a child, and later we'll see the examples, you have a child, you get this thing called working mother child relief, which is a percent of your income, so it can be quite a lot. So for women with children that qualify for working mother child relief, you may not want to do SRS. Okay, yeah, so just take note. Okay, now here's the thing. So you contribute the SRS money, and then basically you contribute, and then when you retire, okay, you can take this out, and when you take this out, 50% of what you have taken out will not be taxed. So if that year you take out 10,000, they will only look at 5,000, and they will not tax that 5,000. They'll compute what the tax is on that 5,000. Okay, let me repeat. If you take out 10,000, okay, they will look at 5,000. IRS will look at 5,000, and they will tax you based on the computation for $5,000, which we all know $5,000 does not incur any tax, provided you have no other income, including rental income. Okay, because rental income is taxable. Okay, so take note, you can only withdraw at the statutory retirement age determined on the year you open the SRS account. So what does this mean? This year, the statutory retirement age is 62. Okay, next year they raise it to 63, and today you in the audience decide to open the SRS account this year because this year is still 62. You open it this year, great. Your age that you can take out your SRS is locked at 62. But if you open next year, okay, you open next year, and the age, the statutory retirement age is raised to 63 next year, then next year you open, you can only take out your monies when you turn 63. And when I say take out, I mean take out tax-free lah. Okay, there are ways to take out even before that, but I will not talk about that in this slide first. Okay, so just take note of that. All right, next. Okay, so basically 40,000 a year, definitely you can take out without paying any tax. Okay, because we look at $20,000 as, or rather not we, but IRAS will look at 50%, which is 20,000, right? And we know that on $20,000, you actually don't need to pay any income tax. So yeah, that's actually a good thing. Okay, so Richard says it's a kind of tax deferment. In a way, yes. Okay, but if you plan it nicely, you may actually end up not even paying. Now take note, there is possibility that you will pay income tax if you don't plan your withdrawal. So I would say the withdrawal strategy is equally important. Okay, but we'll get to that. Okay. So if once, or not say if once you make the first withdrawal, so you can withdraw at 62. But let's say today you are 62 and you are working and you say that, hey, I like my job and I think I just want to work a couple more years to keep myself active. Okay, you are already 62, you don't have to withdraw. You can actually wait until 65 to withdraw. Okay, and when you withdraw that money at 65, your 10 years limit to withdraw. Okay, so there is a 10 years time frame given to you to withdraw the funds, right? That money is actually that 10 years starts at the first withdrawal. So if you withdraw at 65, your 10 years will last you until just before 75. If you withdraw at 62, then your 10 years will last until just before you turn 72. Okay, so just take note of that. Okay. Also, take note that you can withdraw as many times as you wish throughout the year. Okay. Basically, as you withdraw, the banks will keep note of how much goes out, and they report that number to IRS for income tax computation. Okay. So every time you withdraw, okay, 50% of that amount is, they'll tell IRS, and if you cross 20,000, then prepare perhaps that you might have to pay tax. Okay. But take note, once you make the first withdrawal after the statutory retirement age, you can no longer contribute. So please plan your first withdrawal nicely. And I would think that you will want to withdraw when you start retiring. If you are still working, you have a rental income, and your idea of retirement is once you stop working, you also want to sell your property and get cash out, then after you do these things, then you withdraw, okay, you would be able to maximize the benefits of SRS. Okay. So now take note, and this is the part I was talking about. At the end of your 10-year withdrawal period, so let's say you are 72 now and you will withdraw. And if you still have a balance remaining in SRS, 50% will actually be subject to income tax. Okay. Then after that, they tax you on the remaining balance and they close the SRS account forever. Okay. There's one exception. If you have a lifetime annuities, okay, the income stream still has to continue because your annuity was not surrendered. It is still there. Okay. But they will close the SRS account, and then after that, 50% of the income stream for annuity will just be taxed continuously. But it is actually not very easy to reach a amount of a large premium that can give you a 40,000 a year annuity. I think you need like 1 million single premium. And to get 1 million SRS, not say impossible, but I don't see many people aiming to do that. Okay, that lifetime annuity is actually more popular in cash form. All right. Okay, so anyway, the current age of retirement, okay, is 62. So take note of that. Okay, now what if you need to take out before statutory retirement age? Okay, the whole amount is subject to tax. So I would say it is possible, if you really need the money and you might want to take it out, okay, you have to pay tax on the 100% of what you take out plus a 5% premature withdrawal penalty. Now, to me, right, I think this is still okay, because if let's say your SRS has 200,000 inside, okay, you pay tax on 200,000 and a 5% penalty, but you get access to your entire sum of money, which after all the tax and all now, you still have about $150,000 to $160,000 of cash to tap on. Okay, sometimes that tax, that spare cash might be a lifesaver for you. So although there's a penalty, but the fact that you can still access the cash is actually a good thing, like you ask me. Okay, but naturally we try not to get to this point, right? Okay, unless it's really, really unforeseen circumstances or really an emergency. Okay, of course, there are cases where you don't have to pay this penalty. Okay, and for example, if you die prematurely, medical grounds, bankruptcy, things like that. Okay, or you are a foreigner and you have maintained your SRS account for at least 10 years, and then you left Singapore, you can take out without penalty after you meet certain conditions. Okay. Okay. So that's SRS in a nutshell. And the question will be, is it worth your time? Okay. I think that's the question that most of us want to ask ourselves. And then you will see that is it worth your time is determined by how much tax you're going to pay. Okay. So let's take a look at the tax bracket. So take note, I'm going to work with 10,000 as a number here. So every 10,000 you put in SRS, how much tax do you save? So you put in 10,000 and your tax bracket is here, you save $200. Probably not worth it because $200 is, I wouldn't say it's a lot. Okay, it's still money, yes, but I wouldn't say it's really a lot. Neither is $350. But you put in 10,000 and you're in the 7% tax bracket, okay, every 10,000 you put in, you save $700. And we all saw the VTLs being announced. $700. I checked the air ticket price. Someone found a Scoot. I know Scoot is not always the best, the most comfortable way to travel, but someone found a Scoot ticket to Berlin for $460 online. Yeah, so $700 can basically pay for your PCR test and the $400 air ticket to Berlin, Germany. So that's basically a holiday right there, your air ticket at least, right? Okay. Korea, I don't know what the air ticket prices, but I remember before COVID, they are around $600-700. So yeah, that's basically an air ticket to Korea. Okay, return air ticket, not one way. Okay. So at the 7% bracket, it starts to look a bit enticing. Okay. At the 11.5%, wow, you save $1,150 for every 10,000. And it only gets more and more, 1,005, and of course here, every 10,000 you put, you save $20,000. Sorry, $2,000. Okay, so in my view, SRS is actually quite worth it. Definitely once you are below you are at the 11.5% bracket and above. Okay, 11.5% bracket and above. And some people I know, they contribute a little bit at the 7% bracket, not because of really of the tax savings, but it's more like they just want to set aside some money specifically for retirement, and they don't mind enjoying a little bit of tax savings while they're at it. So they contribute like maybe $2,000-3,000, and they just leave it there, right? And get the tax savings, and after that figure out what they want to do. Okay, I have one client, she contributed 4,000, and then she gave birth, and that was it. She didn't contribute already because the working mother child relief was quite a significant amount. So her tax circumstances did not need her to contribute anymore. So yeah, just 4,000, and then that's it. Yeah. Okay. So individual people have individual circumstances. So you probably want to work through your circumstances. Now take note, IRAS actually has an income tax calculator. So I will hang on, let me just bring that up. Okay, so I'm going to share my browser. Can everyone see my browser? Maybe it's been quiet, so hopefully one, if you can see my browser. Okay, thanks. Thanks, Lee Chun. Hello, been a while. Okay, so anyway, they've got these tax calculators here which can actually download and compute. And basically, let me just open it up, and we'll see how it works. Okay. So once again, I'm going to switch to Excel. Okay, we are here on the tax calculator. Can everyone see the Excel? Okay, so let's say, okay, these numbers are pre-keyed. Okay, so let's say you earn $100,000 and you want to figure out how much tax you are paying. Okay, so let's say $100,000, and we'll just put CPF at 20,000. Okay, and then let's say you have no cost fees, and then you earn income relief, and let's say you're a guy. Okay, so let's say NS man 1,500. Okay, so you have release of 22,500. All right, so you are at the 7% bracket. They actually have the brackets here. So useful, right? This calculator. So they actually have the brackets here. You know you are firmly in the 7% tax bracket. So what you can do is actually to just play around with the figure, and let's say you put 15,300 under SRS. You see this taxable income 3,175. It now dropped to 2,104. So you ask yourself, I save this 1,002 in tax, but I need to part with $15,300 in cash. Am I okay with that? Of course, knowing that at 15,300, you can do something. If you think it's okay, good, then go ahead and put. Okay, but maybe some people think it's not very enticing. So what can they do? Okay, maybe don't contribute SRS, right? Okay, no one said you have to contribute, right? Okay, now let's say your income is a bit higher. I'm just going to adjust this to 120,000 now. Okay, and same thing. The maximum relief is to this amount. Okay, now take note. You hover your mouse button over the red arrow there. Okay, you will probably see a bunch of helpful notes, I would say, and they'll explain to you how much you can key in, depending on what you qualify for. You see all these blue links. You click on them, it actually brings you to the IRAS webpage to explain in further detail how the relief works. So Praveen, your question on the cost relief, once you download this calculator, just click on that link and they will actually bring you to the website. All right. So now you are in the $97,100 chargeable income. So let's play around this figure. Yeah, so I pay 5,300 of tax, right? 5,300 tax. If I contribute 15,300 to SRS, my tax dropped to 3,500. That is quite a bit. I think it's about $1,700 of savings. Okay, so yeah, by playing around with the calculator, you'll be able to tell whether contributing to SRS is worth it or not. Okay, so just take note of that. Okay, so this calculator available on the SRS website. You can always go and play around with that. Okay, back to the slideshow. Okay, so there you go. So I would say play around. Yeah, all right, play around and see if the numbers are worth it. Okay, so let's do a simple case study. This is hypothetical. Later on, there'll be a couple of real case studies about my clients. Okay, so Mr. Yong and his wife. Okay, and these are the income. They have 3 children and a parenthood tax rebate balance. And Mr. Yong's mother is retired. Okay, made to help look after the children because Mrs. Yong is working. Okay, so we are going too deep into the numbers. Basically, you can see that these are all their reliefs. Okay, and take note how much relief she has from the working mother child relief. It's so much that if I'm not wrong, her tax becomes 0. Okay, so working mothers, those of you here, yeah, this is a very, very powerful relief. For the men, it's per child, so it's not a lot, but it is still something. So I wouldn't discount that, but it is, you know, definitely lesser than this lah. Okay, so after all the maths and the computations and whatnot, Mr. Yong ends up with a chargeable income of 107,000. And if we remember our table, this is in the 11.5% tax bracket. Mrs. Yong is hovering at $5,000 of chargeable income, so you know she pays nothing. Okay, so Mr. Yong has to actually pay an amount of 6,500, which is 500 a month, and that's not a very small sum. It's actually quite a fair bit. Okay, minus the parenthood tax rebate one-off, he pays 3,500. So what can Mr. Yong do to reduce his tax? Okay, so we have, okay, several actions. Upgrading, provided this is not paid by Mr. Yong's company, donating to charity, topping up mums, and you can see the biggest chunk here is topping up SRS. Okay, so after doing all the maths, Mr. Yong ends up with a further 3,001 in tax savings, and he ends up paying very, very little tax. Okay, you ask me what are the ones I'll probably go for, probably this, and this. Okay, in order probably is 1 or 2 and 1 or 2, or both, right? This one depending on the cost, and charity, that depends if you have a charity you want to support. Okay, but it can be quite a significant tax savings. Okay, all right, so now if Mr. Yong does this for 20 years, and remember SRS fund grows at 0.05, so if he doesn't leave it in the SRS account and does some simple investments or moderate kind of returns on investment, he grows it at 2.5% a year. And 2.5 honestly is not, I cannot say it's guaranteed, but it's not hard. I think it's quite doable. Okay, but I cannot say use the word guaranteed lah. Okay, now at the end of 20 years, this amount will be about 391,000. Okay, 391,000, and if he turns 62 and he withdraws over 10 years, okay, and I assume one thing, when he starts his first withdrawal, actually remember that when he starts his first withdrawal, his 10th withdrawal, right, the amount that is earmarked for his 10th withdrawal actually still got 9 years to grow. He can still continue to grow the remaining balance, but let's just assume he stops here and then liquidate and leave it as cash, which most people shouldn't be doing and probably wouldn't do. Okay, but let's just assume that he stopped and liquidate. Okay, this 391,000 will actually be the equivalent of a monthly additional income stream of 3,200. Okay, and this will be from 62 to 71. Okay, so take note, when does CPF Life start payout? Anyone? Okay, I think I need some interaction. Anyone? When does CPF Life start paying out? Anyone in the chat? No one? Wow, so quiet. Okay, thank you, Darren. 65. Okay. So he can actually start to get a pretty decent stream of income, right, from 62 while waiting for CPF to pay out at 65. So this is one thing to note, that this can be kind of like something like plugging the gap, you know, while you wait for CPF Life payout. And we know that CPF payout starts at 65. What if it gets shifted to 67 or later, you know, in future? But you already lock in your SRS withdrawal at 62. You can actually enjoy some income first while waiting for CPF Life to start. Okay, so take note of that. Not only that, how much tax did you save over these 20 years? $35,000. Okay, so unless you love nation building, $35,000 is quite a fair bit of money that you can do a lot of things with, right? Okay, that's like one child, that's like school fees for one child already. So it's not a small amount of money. Huh? Okay, so let's take a look at how much the SRS money will grow if you invest. And we had used that 2.5% number. Okay, but let's say you manage to grow it at 4%. Okay, this ends up at 56,000. Okay, and of course we don't even talk about the 8% or 6% scenario. That is actually quite a large sum lah. Okay, so what can Mr. Yong do if he happened to do better in his investments and hit 456,000? Okay, actually, to be honest, no need to worry. Okay, why? Okay, so let's say Mr. Yong end up with 500,000 at 62, and then he liquidate and hold 500,000 in the bank, withdrawing it every year at 50,000 a year. Okay, so remember, half of his income is tax, and that will be 25,000. Correct? Okay. The first 20,000 is not taxable, so he's actually taxed on $5,000. Okay, so if I tell you that he's only taxed on $5,000 of income, anyone can remember what is the income tax rate on the first $10,000 after on the $20,000 to $30,000 income tax? Anyone can remember? Great, thank you, Praveen. 2%. So what is 2% of 5,000? Is $100. Is $100 already a lot, considering that he will pay, okay, so over 10 years, he'll pay $1,000 of tax on this, but remember, he saved $35,000 in income tax beforehand. So is it really a lot? I don't think so. And not only that, that $100 is in future dollars, which actually is worth even lesser by then. Okay, so that is actually not a lot, okay, of tax to pay. Okay, so, and also one thing is, if the government changed the tax rate, right, maybe, who knows, $25,000 chargeable income may not even require you to pay tax in future. Okay, why I say that is because our income tax rate have actually been dropping. Not sure how many of you remember. From in 2003, actually the first 10,000 that is chargeable was taxed at 4%. Okay, and then 6 and 9 and so on. Right, you can see that here. Okay, but as tax shifted to indirect taxation, including things like stamp duties and GST, okay, the government lowered the tax. And in fact, in 2007, they actually lowered it to 3.5. And of course, now we have 2% now. And this is 3.5, and then 40 to 80 is 7%. So you can see there has been a drop across the board. Even the 80,000 bracket is now 11.5%. So if GST continue to go up, there may be a possibility, not that I can guarantee anything, but there may be a possibility that in future, this is not 0 to 20,000, it'll be 0 to 40,000, 30,000, who knows, right? So we can only hope, of course, but I also hope that day comes, that will actually be a very good thing for people with SRS. Okay, okay. So that is the previous. Those are the previous tax rates. Okay. So ultimately, should you contribute to SRS? It depends. Okay, and on largely your tax bracket and whether you really need the funds. So for example, I have a client who is quite a high income earner, but I remember the year that he was actually getting married and getting a house at the same time. Okay, I did ask him, so are you contributing this year? Because he's the type that his income actually quite tied to his bonus. So he only really know his bonus at the end of the year. Then he'll decide whether he want to contribute. But usually he has been yes lah. So he told me that I don't think so. I got my wedding and house coming in the next 6 to 9 months, and I really want to hold on to the cash. So, you know, it's a personal choice. He's not forced to contribute, but of course he has to pay higher tax lah since he didn't contribute. But having that extra cash on hand did help him with his wedding and his house right now. So it's very dependent on individual circumstances, I would say. Okay. Okay. So here's the thing. After contributing, a lot of people leave it untouched. Okay, it's a good news that actually now the percentage is over 25, because 3 years ago, I remember reading that the percentage was over 30. So you can see that the proportion of SRS funds that is not utilized is coming down. But I think even in absolute amount, that is quite a large amount of money. Okay, so no prizes, but anyone want to guess what is the unutilized SRS funds in sitting around doing nothing? Anyone want to guess the amount? No one? Or no clue? Okay, to let me just carry on. I see to give you some context. This was 2018, 2.69 billion was doing nothing. That is a lot of money doing nothing. Okay, and that's a lot of money you're leaving with the banks, and banks can do something with that money to enrich themselves, but you are doing nothing. So that was 2018, and actually the percentage dropped, but I understand that this absolute amount is now even higher. So even though the percentage dropped, but the absolute amount I think now is around 3 billion, doing nothing at all. Okay, so it's a bit of a pity because there is so much that can be done with that these idle funds. And when I say so much, what are we looking at? All these investment options. Okay, UTs, FDs, single premium insurance, fixed deposit bonds, shares, and nowadays Singapore saving bonds. All right. Okay. So the question would be, if you invest that money and you want to beat 0.05%, can you do that? Is 2.5 hard to attain? Okay, is it hard to attain? Okay, what can you do with the SRS money to make a realistic attempt at 2.5%? Okay, you got things like fixed income. Okay, so you got your exchange traded bonds or preference shares. Okay, these are listed on SGX. You can just buy and sell like any other stock. Okay, so I'm not going to go in detail. Okay, but just take note, they just trade like normal equities. Okay, and these are what's available. Okay, for retail bonds and perpetual securities. Just take note, there's only one issue which I personally think is a big issue. Frankly, the liquidity is very bad. Sometimes you want to buy, no one wants to sell to you. Sometimes you want to sell, no one wants to buy from you. So you're stuck with the bond. Okay, and of course, I think everyone recognizes this name. You buy the wrong bond, you can also lose money. Okay, so please do your due diligence. Okay, but on the flip side, yeah, if you are in things like Temasek 2.7, I can't remember if that's SRS approved. I believe it is. Okay, that's more than 2.5% already. All right. Okay, because we also have things like okay, so yeah, high flux. We all know what happened with that. Okay, okay, so that's fixed income. Okay, what else can you buy? You can buy shares. Okay, shares, plenty of shares, SGX listed shares, of course, SGX listed ETFs. So I just had a very quick snapshot earlier today, and I remember this number used to be 700 plus. I'm not sure why it's 681, but basically there are 681 shares out there on SGX. I believe not all can be bought with SRS, but a majority of them can be. Okay, and you basically have quite a few options. But again, you need to buy the right stuff. You're gonna buy things like high flux. I rather you not invest your SRS monies. Okay, and you also have listed ETFs. Okay, so these are some of the ETFs. Again, this snapshot was from earlier today. Okay, the I would say popular, I wouldn't say popular, that's more well-known ones, maybe the STI ETF. Yep, they are on the what's the other one? Nico AM. They're on listed and you can buy them. But take note, there is a bit of a spread. Okay, this is the spread. Okay, this one the spread also. And of course, if you are buying something that's not so liquid, just be aware of liquidity issues. The volumes are very, very low for some of them. All right, although not everything here I believe you can buy with SRS. Okay, so yeah, that is these are your options for shares and of course ETFs that are listed. Okay, so I wouldn't say there are no options, just that are the options good or not? So again, like this 681, I think maybe the good stocks are less than 50. Okay, maybe even less than 30 stocks may be worth considering. The rest might not be so good. Okay, but of course, tonight is not a stock picking lesson. We just need to do our due diligence when we buy. All right. Okay, so these are shares. And okay, what else do we have? REITs, always very popular with the retail investor. Okay, so REITs, you can buy them on any brokerage platform as long as you link your SRS account to it. Okay, there are many kind of REITs here. These are just some example of the REITs, okay, that you can buy with your SRS. But take note, REITs, right? This is something that you have to be careful of. REITs may occasionally do equity fundraising, okay, and if you need to take up the equity fundraising offer, okay, and your SRS left no more money, you will be stuck, then you'll be diluted. Okay, I repeat, if you need to do the, okay, sorry, the word slipped my mind for a while, rights, if you have a rights issue and you want to participate and your holding is bought with SRS, and then your SRS, you already use up all the funds or you already contributed that year and deploy already, okay, you may be stuck with a scenario whereby you had to subscribe to rights, but you have no SRS funds to subscribe. Even though you have plenty of cash, you cannot put the cash into SRS. Then you may have a slight issue. So just take note of that. Okay. So generally, I would prefer to use SRS on like shares or REITs that I do not think, okay, will actually have a lot of rights issue or unlikely to have rights issue. So like even the banks might be better than buying REITs, right? Okay, but just take note of that. Again, these are the REITs. Okay, do not this is not meant to be any recommendation or what. So just I think I listed pretty most of them here, but do your own due diligence. Okay, there are plenty of REITs, and to talk about REITs alone could take hours. So I'm not going to do that. Okay, but just take note. Okay, so shares, REITs. Okay, what else? Unit trust is another option. Okay, so actually, okay, this one is a bit small, but let me just highlight. I actually did a search with SRS. Okay, and we have SRS here. Okay, so basically I press find and these are the results. Okay, 10 pages, 10 entries and 105 pages. What does this mean? You got over 1,000 SRS approved unit trust that you can buy on your own on the Province platform. Okay, so that is the range of selection available to you. Is actually quite a lot. Okay, so this is by alphabetical order, so I'm not recommending anything. You can see Asia, China, Europe, what else is there? Technology, India, Malaysia, Indonesia. Yes, even country specific funds are available. Just take note, basically it's a very wide range, geography, asset class, sectors, very, very broad. Okay, so just make sure you do your research again. It's not easy to dilute, but I think to filter down, not dilute, to filter down on what UTs you want to invest in, but just take note, do your own due diligence. Okay, and usually for most people, I would say form a core and satellite approach to your portfolio, meaning that you find some that are good, maybe 80% of your portfolio is in that. So that is the bulk of your holdings. And then if you, let's say, okay, not recommendation, let's say you want to look at technology fund, maybe you can allocate 10%, okay? And let's say you think India may be growing again after they dealt with their Delta wave, 10%. Okay, so if anything goes wrong with this 10% and this 10%, you got a large bulk of your portfolio that's actually still not impacted. Okay, still not impacted. You should still be able to withstand any losses. Okay, so that is what we call a core satellite approach. So these 10% are like a satellite that's rotating around the Earth, that kind of satellite. All right. Okay, so that is for SRS UT. Okay, now so far all these asset classes, I would say they carry some level of risk. What if you are one of the persons here who actually don't like risk, or you felt that SRS being for your retirement is something that you don't want to take too much bet on or take too much risk on, because it is your retirement we're talking about here, right? Okay, so in retirement, I will always say that be a little less adventurous. Not that you can't be adventurous, but try not to be too adventurous. So you don't want to be too adventurous, okay? And all these things here have risk. Then you can look at things like annuity or a retirement plan. Okay, so what kind of annuity or retirement plan are on the market? Plenty. Let's take a look at some of them. Okay, you got Smart Wealth Builder, right? So this is a retirement. Okay, it's not say a retirement plan, it's a savings plan whereby you put in a single premium. So just take note, SRS, right, is always single premium. Okay, it is never shall I say a regular premium thing like your regular plans that you buy with cash. Okay, so you always put in a single premium, and then after that, basically this year, let's say you select this plan, next year you want to buy something else, you can do that. Okay, and you don't have to come back to the same plan. Okay, now, so for this plan, how does it work? You just put in a sum of money, let's say this amount, and the insurer will grow it for you. And at 62, maybe the amount is this much. Okay, I am terrible at drawing, so pardon me. Now at 62, let's say you want to retire, can you cash out? Yeah, you may cash out half, let's say, and then at 63, you cash out the other half. And then at 64, what happens? You see what else you have in SRS and withdraw lah. Now, if let's say, the good news is this, if let's say at 62, you don't want to cash out and it was already this much, okay? Let's say you say that, I'll retire at 65. I don't think I need to cash out at 62. No problem, because this plan keeps growing until you decide to cash out. So let's say you only want to take out SRS at 70, possible, right? Okay, so you want to take out from 70, 80. Maybe by 70, the amount is this much. And then you say, okay, now I want to cash out. Then you can cash out at this point. So until you want to cash out, this plan will just keep growing by itself. So it's a very fast, free way to just let the plan, let the value compound. All right. So that's Smart Wealth Builder. Okay. What other plans? We got Retire Ready Plus. This is a retirement income plan. How it works: put your money in, they'll grow it for you, but then at the age you select, let's say 65, they will start to draw down over 10 years. And I like to spread this plan over 10 years usually. Okay, and then at 75, the plan will have drawn down completely. Just nice also, your SRS account is supposed to close at that point in time. Okay, so that's Retire Ready Plus. Okay, now Grow Saver Flex. I won't go through too much detail again. Another one of those plans. This one's for NTUC. And lastly, we have the Aviva's My Life Income Tree. Okay, now this life income tree is the lifetime annuity I'm talking about. So this means that you can have the payout start at, you put in this sum of money, it grows, and then at 62, let's say, this is the value of the plan. This value will stay there forever, and they'll give you an income every year. Once you reach 71, okay, and then the SRS account close, this amount here is taxed. SRS account close, this income, the little arrows I'm drawing, right, continue as long as you live. Okay, so it's really a lifetime of income. All right, so this is how a lifetime annuity works. Okay, I see a question. Yeah, I made you SRS to buy shares ETF UT, but I do not want to liquidate even when I'm eligible for withdrawal. Oh, okay, CH, you actually don't have to. Okay, for shares ETF, right, we know that you are allowed to transfer from, I assume you mean that, you know, when it comes to withdrawal, you don't want to liquidate and then buy back. All right, that would be very, so like liquidate, take out the cash from SRS, then use that cash and buy back. That will be very tedious, right? If that's what you're talking about, don't worry, because shares and ETF, you're actually allowed to transfer from your SRS account out to CDP. And they will tax you based on the value of the holdings at the point you withdraw. Or rather, not say withdraw, but transfer. So transfer during market crash. For UT, okay, actually, I have not seen anything mentioned by the Ministry of Finance so far. Okay, but my guess is that if you ask them, they'll probably answer you. But I think there should be no reason why, as you can't transfer out the UT from SRS to another holding platform. And you know, same idea applies. They tax you again on the value at the point of transfer. Okay, but UT, take note, is not confirmed yet. But I know shares ETF can. You just transfer from your SRS account out to CDP. Okay, they just tax you at the value at the point of transfer. So I hope that answers your question. Yeah, welcome CH. Okay, so that's the option available. Okay, so what are the common features of these plans? Basically, no risk. Okay, you do not have to worry about market shock or things like that. Okay, and you get a guaranteed yearly income, or in the case of My Life Income, your capital which you put in is actually even guaranteed all the way. Okay, and some plans may have a severe disability benefit. Okay, which means that in your retirement, you're disabled, they give you a little bit more. So that definitely helps. Okay. Again, I would say that there are many options. This is just one lady, age 53, looking for something for about 40,000 in a single premium. And you can see that it's very important to compare. Why? Because things like the guaranteed return is very different. Okay. Between 1.77% and 0.09%, I think no one wants to take 0.09%. Okay, so definitely this is the plan with the best guaranteed return. The non-guaranteed also not bad, even though this may be better, this may be better. Even this is better, heck, but given that this has a pretty strong guarantee, I would say it's a close fight between this one and maybe this one. Okay, because both are above 1% guaranteed returns, and this has a pretty good number. Okay, so ultimately, the key takeaway is there is no best plan for SRS saving or retirement or annuity plans, right? There's only one that is best made for you. In other words, it's got to be customized to your scenario, your specific numbers. All right. Okay. So these are your options. Now take note, I didn't put FD in. Okay. And of course I didn't put SSB in. And the reason I didn't put that in is because I think you really can do better than what SSB and FDs can offer. 2.5% should be doable. Okay, so which is the best? Actually, there's no right or wrong answer. This depends on the individual. All you here may have differing opinions on what you prefer to invest in, and that's the beauty, isn't it? We have so many options at our disposal. We just need to find something that suits us. Okay. Take note, right, that when investing in all these, right, okay, like buying shares, REITs, okay, you have to pay brokerage when you are buying off the exchange. Fixed income, same thing, is still traded. You have to buy off a broker platform, you have to pay brokerage. But in terms of transactional fees specific to SRS, all the banks have waived them and they are still waiving them as far as I'm aware. Okay, so don't worry about paying anything excess because the banks don't charge anything. It's only say the brokerage firms. Okay, unit trust, if you know the right place to buy, also practically zero fee. Retirement saving plans all along is just the premium you pay and that's it. If you choose to buy SSB, this one, the banks will charge an application fee of $2. Okay, $2. So this is, the bank will charge you this, but other than this $2, everything else here don't have a fee. Okay. I see a question, among fixed income, which option preferable? Frankly speaking, this is provided fixed income is what you want in the first place. Personally, I don't think there's anything attractive right now, even that if there is liquidity is an issue. So Pola, I think this really have to see whether you like fixed income in the first place. Then you have to look at each of the options and decide whether you have found a suitable option for fixed income. All right. Okay. So what's the strength of SRS? Remember, SRS is something meant for retirement, and if you deploy it and you have 10 years to take out, okay, you can actually spread your withdrawals and use it to pad your retirement in a certain way. And at this point, I actually want to highlight something called sequence of return risk, which is something that some of you may not have heard about, some of you may have. You have, just bear with me. Just a show of hands, if you have heard of, okay, you have not heard of sequence of return risk, can you help me type a 1 in the chat box so I have an idea of how much you all know about? Okay, really a lot. 1, 2, 3, 1. Remember, one is have not heard of sequence of return. Okay, a lot of ones. Can, no problem. Let me explain sequence of return risk in the easiest way possible. So basically, when you want to withdraw your monies in retirement, okay, any early losses, meaning market losses, can impact your portfolio. Okay, so even though we say the market gives an average of 8% in the long run, 10% in the long run, okay, it's not important at the point of retirement. Okay, you need to hedge the way you take care of money, and you need to have a proper strategy so that you don't run the risk of running out. And the best way to show this is with this example. So let me just read off this picture. Okay, so basically, we got two people here with 30-year time frame that they are intending to withdraw their monies, right? Okay, so the solid line, okay, so Mr. Red color, the guy with the red color withdrawal plan, okay, he started withdrawing for his retirement, but at the same time, the market crashed, and not only crashed 3 years in a row. So after that, at around 64, the market recovered, but because he still need to withdraw, and how much he need to withdraw is 12,500 a year, adjusted 3% for inflation. Because the market crashed so much, by the time the market started to recover here, the funds cannot sustain already. He can make returns after that, but it cannot keep pace with the 12,500 every year. So in the end, the amount dropped to $4,000 by the time he is 80. Okay, but the dotted line, okay, the good news is the dotted line, the losses come at the end. In other words, the returns, the sequence, when was the good year and when was the bad year. For the red line, the sequence is bad first, good later. Can follow? And for the dotted line is good years first and bad years later. So because the good years came first, while he withdraw 12,500 a year, his market value of the portfolio still go up. Okay, Praveen asked me to explain again. Okay, let me try again now. Okay, red line. Okay, we look at the red line. It starts with 3 years of negative return. So his $250,000 suffered losses, but at the same time, due to retirement, he still need to take out 12,500 a year, adjusted by 3% for inflation. By the time the losses end, and that means year 4, the market starts to recover. So the market started to recover, right? But his portfolio has shrunk so much that even with the market growing, because he still need to take out 12,500 a year, his portfolio value just keeps shrinking. And it ends with 4,000. So his plan to have 30 years of income from his portfolio only lasted 20 years. Now for the blue line, he also withdraw, but the markets had positive returns. Okay, so the negative returns only come at the end. Okay, so the market had positive return. So as he withdraw, the portfolio went up. So the portfolio actually keep going up even though he's taking out money because the positive returns are there. Okay, and only at the end when the market crashed, then you see his portfolio drop a lot. Okay, but the fact is he managed to make it last on the 90 years. So what's the story? The story is, or rather not say story, the moral is this: because we will never know how the market is like when we withdraw. Okay, sequence or return risk is a very real risk. That means that if you didn't plan for it, okay, if the market crashed the year you retire, like last year, right? Last year the market crashed severely, right? I think in March and April, no one knew when the end was in sight. If the market crashed like that again when you retire, okay, it is a very real possibility that you actually have your portfolio draw down faster than expected. But if the sequence is different, okay, then you know your portfolio go up instead of dropping. Okay, AY asks how to hedge against such risk. Okay, basically you need income that is not correlated to market. Okay, what I mean by that, I'll explain a little bit later on. Okay, AY, there's a little part about this at the end. Okay, no, crypto is so volatile. Okay, anyway, I'm not allowed to talk about crypto. It's not licensed by MAS, but let's just put it this way: crypto moves like market, right? AY, up and down, and the swings is even bigger than most market. I don't think you want to be on the wrong end of the swing when you retire. Okay, so no, hedging against this risk is not done by crypto. Is done by market independent income. Okay, gold, silver dependent unless you are willing to sell. But again, the value of gold and silver can swing up and down. So you might be selling a loss. Okay, so Richard, not exactly true. Okay, if gold prices and silver prices drop for whatever reason, let's say the year you retire, you also have to, go sell a loss. Unless you're talking about the inverse correlation, but then that's another thing entirely. Okay, now, so sequence return risk, okay, we'll address that. Okay, now let's talk about a real life scenario and we'll wrap up the seminar. Okay, so this is a real life scenario, but I will focus on the SRS portion. Okay, these are my real clients, Mr. P and the wife, Mrs. S. Okay, so they are married with one son. Okay, I first knew them in 2017 when they were 40. And so, we just had a chat and then they said, okay, can you share more, right? Share more about what you can do, meaning what I can do for them, and what things that I can propose that may help them, kind of like put their finances in a better place, right? Okay. So they also have a mortgage on a property. So it was about 1.2 million. I remember they're staying in a private property. And both of them are middle management position in civil service. So very stable income. Okay. But yeah, a lot of red tape according to them. Anyway, so the priorities are the family. Okay. As you can tell, their son, they only have one child. Even till today, I actually talked to them a couple of weeks back on Zoom. The son's now in primary school. So you can tell back then their son is actually very young and they want to spend more time with him. And due to being in a civil service position and they're not like they're in middle position, apparently middle management really a lot of paperwork. Their work hours don't leave them with a lot of free time, and their free time is mostly spent with their son. Okay, so this is their profile. Okay, so I asked them, have you heard of SRS? And they said, what's that? So I went through the same explanation which I've just done in the past 1 hour. And the long story short is basically, this is the actual screenshot of their income tax statement in 2017 based on 2016 income. You can see that the husband paid 5,500 income tax. Okay, and these are their reliefs. Notice that SRS is missing. So I explained to him. At first, he was a little like, you mean put so much, into my SRS and I can't touch it? I said, not say you can't touch it, I told him, but you can do something with it, and it's still your money. You can touch it when you retire. He said, okay, let's try. So next year, this was his income. Take note, his income from 138,000 went to 148,000. So he got a bit better bonus and he also got a pay increment. Now, anyone, I know I'm covering the amount now. Anyone here remember what was the tax that he paid in 2017? Anyone? No one. Can't remember already. 5K, good. CH, great. Yes, 5.5K. But take a look. Wow, probably give me the exact number. Fantastic. Okay, but take a look. This time round, he put SRS, his tax dropped to 4.8K. So he actually paid lesser tax. He was actually quite intrigued. I was like, hey, I actually end up paying lesser tax. I said, yeah. I told him, yeah, that's the whole point, isn't it? How you to pay lesser tax. Okay, and the wife, this is the wife's income. Okay, so same thing, but take note this time around, she paid a lot lesser than the husband. Okay, and it's largely due to working mother child relief. You can see this is a very, very significant chunk, $20,000. So with that working mother child relief, her chargeable income hit this because her release were at 56,000. Okay, that's quite a fair bit of release. Okay, Okay, now she is in the civil service and she's under a scheme where every few years they get a bonus payout. Okay, I think some of you probably can guess, but I just don't want to say what it is. Okay, so she was due for a bonus payout that year. The husband wasn't. The husband's bonus payout is a different year. So what happened to my clicker? Okay, so her income the next year was $181,000 due to that bonus payout. Okay, and this time around she put that 15.3 into SRS. Take note, her income tax also went up. No choice. When your income jumped by 50%, SRS can only do so much to mitigate your tax. But see how much relief she had, very close to the $80,000. Now, this is because she has one child. If she has 2 kids, I will tell her don't need to do SRS. There's no point. This one alone will already be like 40,000 or something like that. So she does not need to do SRS. But because she only got 1 kid, SRS may actually help her. Okay. AY guess, is she a teacher? Yeah, something like that. Yeah. Okay, not in the armed forces. That's all I can say. Okay, so that's her relief. So basically, if we look at the numbers, okay, so if without SRS, right, the husband's income will increase by 7.1%, but the tax will increase by 18.6%. That's actually quite a fair bit. Okay, but because he did SRS, his income increased, but his tax decreased. I repeat, his income increased, but his tax decreased. Okay, that's a good thing, no matter how I look at it. For the wife, okay, the wife, interestingly, if she didn't do SRS, we computed the tax. Her income tax would have to go up by 2.5 times. That is a lot. Is it 2.5? Yeah, about 2.5 times. Okay, but because she did SRS, we are now at 2 times. Okay, yes, no choice. Her income her income tax has to increase. Okay, but it is not as drastic as 7,006. So as a family unit, just by doing this, okay, without SRS, their tax bill will have almost doubled from 8,000 to 14,000. But with SRS, their tax bill only increased by a modest $2,000 plus or 25%. And yet their absolute income increased that year by 60 over thousand. Okay, so this is an example of how SRS alone can confer quite a fair bit of savings on let's say a married working couple. Okay, so I always like to tell my clients this: please increase your income, but please try to, don't increase your income tax at the same time. But you have to, no choice, but try and mitigate the absolute amount of increase. All right. So now we got husband and wife with 15,300 each in the SRS account. What happens next? Hey, so after saving income tax, right, they were looking to do some planning. Okay, they said, hey, that's great. So what do I do now? Okay, so basically what I did is to take actions across various aspects of their financial plan. There's a lot of things, but let me just focus on SRS parts. I'll touch on what I did for them a little later. Okay, now, as I mentioned, Mrs. S, she's not expecting that large bonus every year. So next year she is not, or rather that year after that, she was not expecting to contribute to SRS, because I told her that, look, you contribute, yes, you still save tax, but the savings is probably 7%, that kind of tax bracket, which may not be so attractive to you. She said, yeah, that's true. So, I won't contribute until I get another big payout. Okay, now, Mr. P, the husband, will continue to contribute every month, and he is actually the one who set out a standing instruction every month to contribute 1,275, okay, every month. So by December every year, he will hit his 15,003. And they decided, due to the fact that their family and personal time is very important to them, they decided to deploy or invest the SRS through something called advisory unit trust. Okay, so they looked at SRS UT. Okay, now fixed income, I think they were turned off probably by the lack of choices. Stocks, they are not familiar. Okay, and then actually their saving and retirement plans were done with cash, so there's no need to duplicate that with SRS, but that is just their particular scenario. Okay, so basically this is the advisory unit trust, and this is the husband's account. The wife's account, I think there's no regular contribution, so the amount is lesser. But the point is, okay, we set this up at the end of 2017, and then after that, at 2018, we started to deploy the funds. Okay, so we went in first, okay, and then started to deploy. Okay, so that is 2018, and today, okay, because the husband is contributing every month to SRS, so every month he contributes his salary to SRS, and from the SRS, I take out the contribution to do dollar cost averaging and go into the market. Now, I'm not trying to time the market for him. He also understands that no one can time the market because he knows if I did, I can, and I'm successful all the time. I'm not giving this seminar to you today. I will be retired somewhere else already. So we do dollar cost averaging. We buy in. Sometimes when the market did a bit more, we may buy more, so on and so forth. But as of end of September, okay, with RSP, he has contributed $38,000 and his market value at that point was 44. Now we know the markets have come down a little bit over the past 2 weeks. Naturally, now I think it's about 42 perhaps. But the point is, he is still in profit and it is a pretty decent double-digit return. Okay, what I want to point out here is that this took 4 years to achieve. Okay, not say 4 years, maybe 3.5 years so far, coming to 4 years end of this year. But the idea behind this is that don't try to time the market if you are just going in for the long run. Just consistently invest and let the market do the rest for you, as long as you hedge yourself in terms of making sure you got plan Bs and making sure you choose the right unit trust and things like that. Or rather, in my case, is to help them to manage in the right way. So if you note that actually, you can see here there are actually 5 funds, 1, 2, 3, 4, 5, and this is just a dollar value thing. You can ignore that. Over here, we actually expanded the portfolio because as time grew by and the portfolio grew bigger, I am able to diversify just a little bit more. Okay, so now Mr. P is now with 6 funds. Okay, so in returns, how has that been? So take note, so this is a screenshot on the same day. 44,000 is the market value. So this is the same 44,000. Okay, I did tell him, sir, I'm not trying to grow aggressively. Okay, we just need to make sure your funds grow better than 0.05 and it create a meaningful amount of money for you by the time you want to retire. So, okay, so this is advisory rate. You can see it's SRS. Okay, as of end September, he's sitting on around 5% per annum return. Okay, this is the return computation by the system, so it can't be wrong. 5%, give or take a bit. Okay, so is 2.5% hard to beat? Going back to the question I posed, I don't think so. I think it's quite easy, but I can't guarantee it. It's just doable. Okay, it's just doable, and I don't think we should be content with just letting 0.05% be our returns from our SRS funds. We should try to do better. Okay, so to him, 4%, 5%, he's happy because he's tried stocks before back when he wasn't so busy, and he's lost money, and he's still clear of stocks ever since. Mr. Zhang asks, okay, Zhang says, will DCA pay more brokerage? No, this is unit trust, so there is no brokerage fee. And Pravin, yes, Poems unit trust, no brokerage, but this is actually advisory unit trust, which is not through Poems, is through my the portfolio that I'm actually managing directly for him. So Mr. P actually does not. Yeah, I just realized that he's same as you, Pravin, but he's not Pravin. This Mr. P here, my client, he actually does let me handle the portfolio for him. Okay. Darren asked, reinvest. Yeah, in this scenario, actually, I'm reinvesting his dividends because even if the dividends are payout, he can't do anything. So might as well reinvest. Okay. So these are his returns. And yeah, if we don't have unrealistic expectations like 10% a year, 5% a year is actually something that I would think is doable. Okay. And of course, why advisory? Okay, to them, right? What they were drawn in by was basically that. Remember how I said there were 1,000 unit trusts available in SRS? Which one is good? By the time they research finish, I think 3 months passed already, and maybe everything changed again. Okay, so in this case, fund selection is handled by myself and the team, and so basically we take the work off them. Okay, not only that, okay, they can focus on their job and their family because the monitoring is done by us, myself, and scalability. We actually can scale up the portfolio for them. In tandem, as their funds grow bigger, you notice I added another additional UT for them to kind of like diversify a bit further. Okay, and to them is basically they said to me, they said this: you're the finance guy, meaning I'm the finance guy. Yes, that's my role, right? That's my job as a financial advisor. So basing off my knowledge, which they said that definitely I have more knowledge than them, and not only that, I have the time because it is my job and it is also my experience all these years managing for them. That's what they were looking at it. This is the value add to them. Okay. Not only that, behavioral and emotional coaching. Of course, naturally they were worried last year when the market dropped, but I basically I would say talk to them and explain to them how to look at things. Okay, so it's a bit of a cannot say it's counseling, but it's kind of like managing to set their expectations and emotions straight. So that helps them to stay calm during the market dip last year in March. Okay, not only that, I actually plan a withdrawal strategy for them, which I will show in the coming slides. And skin in the game, what does this mean? Whatever they buy, actually, I also buy. Personally, in a way, it's like saying I test the fund first, and if I'm confident that I can make money, you get the funds as well, because if it makes money for me, it should make money for you. Why not, right? Everyone wins together. So yeah, whatever funds they have, okay, I do have them as well. Okay, so that's why to them, this advisory, which I'm working for them, but they feel that the cost of this advisory is something that is intangible to them, because they're free to concentrate on other things like family and work. Okay, so Darren asked, what is advisory UT? Or are you referring to the charges on the advisory UT? Okay, I will talk about that here. Okay, so these are just a sampling of some of my clients on advisory UT. You can see that these are advisory and all are SRS. Okay, depending on portfolio size, it ranges from 1.5 to 1.25 to 1.5%. But the value you see here basically has already accounted. This snapshot was taken end of last month, so this value here already take into account the advisory cost. Okay, advisory fee. Okay, and basically ignoring portfolios that started, not say ignoring, but discounting portfolios that started recently. Remember, in the first year or two, you can't really expect to see a lot of returns. But if you hung around long enough, yeah, most people are making returns. And okay, in Chinese, there's I will just say it this way, 不要输钱就好, which translates to don't lose money can already. As long as I can make some money, I think I should be content. Unless you are a very savvy investor, then what are you doing in this class? You should, be making money off the US markets right now, right? Okay, but not everyone is like that, and not everyone has the free time. So this is advisory UT rep, where clients are just investing, and I'm helping them to oversee and manage. And actually, I'm just happy that everyone's making money. I think we just want to make money and have more for our retirement, right? Okay, so this is advisory UT rep. Okay, and yeah, the returns. Okay, now again, let me just stress, these returns are not indicative of future returns, but having run this for a few years now, I think yeah, money can be made when investing. That's the message I'm trying to point out. Okay, so yeah, if let's say okay, this is a, let me see. Oh, okay, this one is a 60-year-old lady. When I first knew, no wait, when I first, she's 50 something when I first knew her. Now she actually lost some money on SRS investment, so she was trying to make it back, and she is still working. She's now 62, yeah, 62, and she actually said, can I try to make back her losses? I told her no promises, but I will have to allocate your portfolio in a more aggressive manner. So her returns are a little higher than the 4.9 you saw. This is about 7.2%. But again, it just goes to show that, with proper allocation and fund selection, you can actually make money off the market. Okay, and she is nearing retirement, so of course, I hope to grow this closer to like 100,000 by the time she retires, hopefully. Okay, so yeah, different people will have different returns depending on market timing and preferences, but ultimately, I think it is possible to make money, definitely. Okay, so that is what Mr. P did with his SRS. The wife also did SRS, but of course, she just went in as a lump sum first because she doesn't have a high salary every year. So until her next payout of that extra bonus thing, then she may contribute SRS again, and then I will continue to look at what to do for her. So additionally, what else they did? Okay, just as a quick sharing, we upgraded the ElderShield supplement. You may remember they were 40 when I knew them, so prime time for upgrading ElderShield. Okay, they had a mortgage, remember? So I looked at the mortgage insurance. I helped them to find something that is of the same coverage but is cheaper, and actually that saved them $26,000 in premiums over the years, which is again not a small amount of money. Okay, I sorted out their son's critical illness cover. For those of you who don't know about this, children can buy CI coverage, and not only that, when they're young, it's so cheap. It's frankly the cheap, really the cheap. Their son was 3 years old at the time. It's really very cheap. Okay, I mapped out the retirement strategy and helped them to take basically massive action towards their retirement. And one thing that they could say is that when I talked to them, but this was last year before COVID, around early January when we met for lunch. They said they felt a bit better knowing that they started to take some steps to address their retirement. Okay, so in a survey, and this came out in the Straits Times very recently. Okay, plan early so you can. I think the keyword is this. We all know you need to plan, but when? And I would highly encourage that you want to plan for retirement SRS is one of those tools. Plan early. Okay, so the survey basically finds that if you start planning early, you start before the age of 50, you have $600 extra when you retire, compared to you plan starting age of 50, you may end up with extra, but only $300 extra. So planning early helps. Okay. Okay. So now going back to the sequence of return. So ultimately, when you plan for retirement, you need to have multiple sources of income. SRS is just one of them. And a sound strategy is basically having multiple sources of income. It's like a big river will always have the river is basically fed by multiple small streams. Okay, so if one stream dries up, the river still continue to flow. Okay, so here's the thing. Income sources can be guaranteed or variable. And to mitigate sequence of return, remember that I said we need to have income that is not correlated to market. Okay, in other words, guaranteed income, because a guarantee is unaffected by the market. Okay, I repeat, a guarantee is unaffected by the market. So this basically means that whatever you need to meet in terms of your guaranteed bills, you got to make sure it is guaranteed, backed up by CPF, retirement plans, and maybe say your CPF withdrawal. Things that you know are not guaranteed, stocks, REITs, UT, use that to meet expenses that are variable. For example, holidays and dining. Look, no one's going to go on a holiday. No one has been on a holiday for the past 1.5 years, and so it just goes to show that holidays is not a essential expense. Okay, some people say, oh, I'm going to die, you don't go on holiday, but no, holiday is actually not essential expense. Okay, look, we're all stuck at home, right? So that's the thing. Okay, so non-essential expense, you can use non-guaranteed income to pay for it. Essential expenses, things that need to be paid for, you got to use guaranteed income. Okay, and of course, you got other sources. SRS, as I mentioned, could theoretically fit in variable or guaranteed depending on what you deploy your SRS in. So I can't really classify it, but it fits both ways. Okay, so AY, just like you asked how to address sequence of return, you need guaranteed income. Okay, and this is actually the retirement planning. I know it's small, but it's intentionally small so you can't see too many details. Okay, basically you can see how this works. I map everything out for them. Okay, and you can see that over time their health, okay, I would say health balance increases. These are all the expenses down to the last detail. Of course, not like decimal point, but as accurate as it can be. So this is their retirement cash flow. As they work and accumulate wealth in the green bar, eventually they will reach a point where they have to retire, and then they start to draw down. So they build, and the rate of increase of the green bar is faster here because by then their son is expected to go out to work, so there'll be lesser expenses, mortgage towards the end of paying off all that, so they can accumulate even faster. And then when they decumulate, okay, and then the question is, when do they run out of money? Okay, so last I checked, they run out of money at 89, which is good enough for them, but I think can do better. But again, we shall review every few years just to see how it's on track. So this is the total planning, that we did for them. I did for them. All right. Okay. And I had shared with them this year. Their mom sold a flat and they have a sum of money sitting down and they're asking what to do with it. So we are exploring doing something called legacy planning, which is where I create a stream of income for their son, but this stream of income is only after they're no longer around. When they're around, they enjoy this, and then when they're no longer around, it goes to their son and it'll give them a helping hand. Not much, of course. I think we are looking at giving their son an extra 5,000 a year, which will not make him retire, but it will definitely help him, relieve a bit of burden in terms of expenses. All right. So that's the case study of Mr. P and Mrs. S, and how SRS actually was put to use to put to work for them. Okay. So it's 9:28. I just want to end on time, and I just share with you some concluding thoughts. Okay. SRS can definitely benefit you, even if it's not now. Some of you here, maybe you are young. There are 50 of you here. I'm not sure what's your ages, but let's say you're young, your salary isn't a lot. It doesn't matter because your salary will increase in time, definitely. So please open your account first. Okay. Just make sure you got your account open. Lock in at age 62. Second thing, if you already open your account, your SRS funds idling around, please deploy them. As I've shared, there are a lot of things you can deploy them into. Seek out help if you need. All right, it's okay to ask for help. Okay, no one knows everything. Okay, so time waits for no one. What's worse is if you don't do anything and then you just lost time. Okay, and lastly, since this all ties into retirement, please take some action about your own retirement. A lot of people actually don't take action. I find like they promise themselves to take action, but after that they get lost in work and or family or things like that, and or they forgot. And if tonight you want to take home one thing, it's really the last line. Okay, please take action to secure your own retirement, because no one can help you unless you want to help yourself. Make sure you do proper planning for yourself, and with your advisor that may help you to identify things like saving on your insurance premiums, which is still money saved, any gaps in protection, how to build the retirement drawdown, which is actually this thing that I showed earlier, right? So how to build these kind of things and make sure that you have plans in, you have a solid plan for your retirement. All right, okay, so it is 9:30. Okay, I have managed to end on time, and at this point, although I know you guys have been asking questions throughout, thanks for that. Actually, I feel like I'm just talking to my webcam. If you have any more questions, please feel free to ask. If not, I would say thank you very much for attending. Okay, here's a question I heard. How can I contact you to explore SRS or retirement planning? Okay, actually that's a good question, which was actually brings me to our next slide. Okay, for all of you here, if you would like to reach out and get some I say advice maybe, or you want to explore things like the SRS advisory, whatever it may be, okay, I'll say scan this QR code and save my contact. If you prefer to just manually key in my contact, that's my number on the screen, but if you want to make it easy, use that QR code and it should open up in your phone with inside the contacts folder. Okay, and then you can save my contact. My name is Elijah, and it has been a pleasure having you tonight. Yeah, so I'm just gonna leave this screen here and I'll be taking any questions. If not, you may feel free to enjoy the rest of your evening. I've reached the end. Thank you so much. Yeah. Thank you. Okay, and if there are no questions, then we will end the meeting in another 2 or 3 minutes. All right. Thank you. Oh, okay. There's a question. For those of you still here, the 17 of you, how do we sell and buy shares or UT using an SRS account? You actually, the SRS account is an account with the bank that you put money into, but to buy or sell your shares or UT, right, you actually need a brokerage account of some sort, Poems or okay, I'm from Philip, so I can only say Poems, but there may be like your bank, like Vickers, all that. Those accounts will allow you to transact your SRS funds into whatever asset class. Okay. So Chan, I hope that answers your question. Yeah, welcome. Okay, if there are no more questions, I think we shall end the Zoom. And for those of you who have needed to save my number, I hope you have it. The QR is there. And thank you very much for attending. We'll see you again soon. I'm sure there will be more seminars in the months to come. Thank you.